Welcome back to the K Show. Let me reset the conversation around AI. The bottleneck is not talent. It is not chips. It is not algorithms. The real bottleneck is how you finance compute at scale, without detonating your balance sheet in the process. Today, we are not analyzing Meta's models. We are analyzing how Meta paid for the infrastructure that runs them. This is the Louisiana data center deal. This is Blue Owl Capital. This is the architecture of capital. Meta is entering the most capital-intensive phase of its existence. AI data centers are not incremental investments. They are industrial-scale bets, tens of billions of dollars, long duration, power-hungry, politically visible. Now here's the tension. If Meta had placed a $27+ billion AI campus directly on its balance sheet, three things would have happened immediately. ROIC would compress, credit metrics would weaken, investor narratives would shift from AI leadership to capital risk. Meta didn't want less ambition. They wanted less visible financial drag. The objective was precise. Build hyperscale AI infrastructure without structurally impairing Meta's balance sheet optics. This is not about hiding debt. This is about where the debt lives. That distinction changes everything. Meta partnered with Blue Owl Capital, one of the largest alternative asset managers specializing in long-duration, infrastructure-like credit. Together, they created a joint venture, commonly referred to through Beignet Investor LLC, to finance a massive AI data center campus in Louisiana, often called the Hyperion Project. Here's the critical design choice. Meta takes a minority equity stake, around 20%. Blue Owl managed funds take the majority, around 80%. The JV, not Meta, issues roughly $27 billion of debt. Why does that matter? Because under accounting rules, control determines consolidation. Meta deliberately structured the venture so that it does not consolidate the JV. The JV's debt does not sit directly on Meta's balance sheet. This is not aggressive. This is textbook financial engineering done at scale. Meta does not need to own the concrete to own the compute. Instead of booking a massive capital expenditure up front, Meta leases capacity from the JV. Let's be very clear and accurate here. Under modern accounting standards, operating leases do appear on the balance sheet as right-of-use assets and lease liabilities. So, where is the advantage? In measurement and perception. Because only the non-cancelable portion of the lease is recognized. Long-term renewals remain conditional unless reasonably certain. The financial impact appears staged, not explosive. The result? Smoother expense recognition, less ROIC distortion, far more predictable cash flow optics. This is not cosmetic. This is narrative control through structure. Now, here's where sophistication shows. Yes, Meta likely provides economic support mechanisms, long-term usage commitments, value or performance assurances, alignment incentives for Blue Owl's investors, but those risks are contingent, distributed over time, not immediately visible as headline leverage. Markets don't price future hypotheticals aggressively. They price current structure. Meta understands this distinction perfectly. Now here's where sophistication shows. Yes, Meta likely provides economic support mechanisms, long-term usage commitments, value or performance assurances, alignment incentives for Blue Owl's investors. But those risks are contingent, distributed over time, not immediately visible as headline leverage. Markets don't price future hypotheticals aggressively. They price current structure. Meta understands this distinction perfectly. This architecture allowed Meta to do three things simultaneously: scale AI infrastructure at hyperspeed, preserve balance sheet and credit optics, protect its equity multiple. Most companies sacrifice one to get the other two. Meta designed a structure where nothing had to break. That is senior-level capital strategy. Three takeaways every future leader should internalize. First, ownership is optional. Control and priority access are not. Second, accounting rules are not barriers. They are design parameters. Third, in capital-intensive industries, the winners are not the boldest builders. They are the best capital architects. The AI race will not be decided by who has the smartest models. It will be decided by who can. Finance infrastructure at scale. Maintain investor trust and grow without triggering fear. Meta understood that. This is not a data center story. This is a capital story. Until next time, keep your strategy sharp and your balance sheet even sharper.